Hey guys, I'm here with Patrick Queally, and I'm very excited today. I have seen Patrick speak multiple times, either through a lot of NICS organizations and most recently at our brokerage. He has some excellent information. I was particularly impressed with the information he had for VA programs. My husband is a police officer and also a vet, so
I didn't know that. I didn't know your husband was a vet, Maryann.
Huh?
I didn't know your husband was a vet.
Yeah.
Okay, well, thank you for your sacrifice and thank him for his service.
Thank you so much. I appreciate it. Yeah, he's a vet. He's still, on the front lines as a cop in Methuen. We feel very grateful for all he does. So, and of course, we want to always take advantage of the vet programs when we can, because they do have some really good mortgage programs. So I want to jump right in a little bit with Patrick's background and his career in the mortgage industry. He started as a loan processor in '93, I believe it was, correct?
Yep, 93.
Yep, he was promoted to an underwriter and later named vice president of residential and commercial mortgage lending, which is pretty amazing, at a local community bank. He maintained a big pipeline of residential and commercial transactions, really from the beginning to the end, right? From the beginning to closing.
Yeah, so at a small community bank, you never really let go of any duties. They just keep adding more and more on.
Right. And through, of course, as the years progressed and as Patrick got more experience, he worked in a variety of lending institutions as well. You worked for national lenders, correct? And also regional and community banks.
Yes.
Yeah, so he's definitely, he knows his stuff. And then in 2017, was it? You were 2017 producing branch manager for a growing national correspondent, and it's Hancock Mortgage Partners, correct?
That's correct, yes.
Awesome. So he serves on the company's, even on the advisory board for them as well, correct?
Yes.
All right. So Patrick has a ton of information, and if you've ever listened to him speak like I have, you're going to get a lot out of today. And obviously, I think that Patrick should be sharing everything he has with the world. He even has a podcast. Tell us about your podcast.
Yeah, so in addition to being, producing branch manager here for Hancock, I do have a podcast series.
Wait, don't tell him the name yet.
Okay, all right.
Because if you're from New England, the name is perfect.
Yeah, and that's really why I chose it. So parts, or maybe this whole interview is going to be repurposed for that as well, of course, with your permission. So the interviews I do are with local small business owners in the community, real estate agents, financial planners, insurance agents. It's sort of real estate centric, but I'm branching out beyond that. And it's really, more of a shop local movement, support the local businesses in your community. And that was all before this whole, COVID-19 came about, and there's more of a support your local businesses theme going on right now. So it's the podcast that I have been doing. I've actually been inviting people into my office, and we've been doing it and broadcasting it live, shifting gears, obviously, with everything that's going on, and more of the interviews are taking place like this is with a, video conference.
Right. Which is kind of the nature of what we're all dealing with right now. So, all right, tell us the name of your podcast, because when I saw this, I was like, well, this is perfect for Boston, perfect for New England.
Yeah. It is the Wicked Awesome Report.
I love it.
So a friend of mine in California who has a longstanding video blog, I spent some time out there with him, and of course he's making fun of the Boston accent and everything's wicked awesome, and he introduced me to one of his friends as, hey, he's this wicked awesome loan officer from Boston, and then from then it just stuck. So that's the sort of the theme, or the motto, the tagline that I'm going with, the wicked awesome loan officer.
Does he think you have the big Boston accent, that you drop your R's and?
According to him, I do, but again, he's based in California, so what does he know?
I think the further out we get from Boston, we get our R's back in, but if you're from even New England, if you go somewhere outside of this area, everybody thinks you're from Boston.
Exactly.
So I invited Patrick on today. I really wanted to get his thoughts and his perceptions of what's happening right now with the economy and our country and mortgages. I'd love Pat to give a quick overview of what we've already seen, what's already happened, and what's going on, and what his predictions are, and what they're likely going to be for the future. And I think that's going to help us put into context how and why some of the questions I have for him today are pertinent. So, I do want to talk about forbearances, and I do want to talk about modifications, what homeowners should do right now. So if you have anything to add, throw it in, Patrick.
Okay, great. So I think the best thing to do is just to try to put it into a bigger picture context. Take a look at what's going on from an industry level, what's happening in real estate and mortgages as a whole, and then take a look at, describe a little bit what's happening to the individual consumer. Okay.
Sure.
So that will help hopefully put it into a context, may actually answer some of the questions, but I'm sure is going to lead to a whole bunch of additional questions. So right. From an industry perspective, sort of set the stage here as to how a mortgage transaction happens. Okay. So, Maryann, I'm going to use you as an example. You're the borrower. Okay. Mm-hmm. So you're taking out a mortgage, you're buying a house, and you're borrowing $300,000. Okay. So when you get to the closing table, the mortgage lender that you're working with, and again, this is not across the board with every single transaction, but this is a typical example of how it works. Okay. So you get to the closing table, the lender that you're working with has to send $300,000 to that closing attorney to fund your transaction. Mm-hmm. Well, that mortgage lender has to borrow that money in most mm-hmm. cases. So they have what are called warehouse lines of credit. Okay, so you think of it like a consumer's, credit card or a home equity line of credit, except it's a much larger dollar amount. So the mortgage lender borrows that $300,000, wires that $300,000 to the closing attorney to conduct your closing and fund that transaction. Mm-hmm. The attorney disperses all the funds to the seller and every place else it needs to go. The mortgage lender gets your closed loan file back, make sure all the paperwork is signed correctly, and then typically what happens is that loan is going to be sold on the secondary market. It's going to be transferred to a loan servicer. So when it goes to that loan servicer, the loan servicer is going to review the package, make sure everything is, sound underwriting principles were used to calculate income and review credit, okay? And that mortgage loan servicer is now going to pay for those servicing rights. So they're going to pay the mortgage lender that you took the loan out with the $300,000, the principal loan amount, plus let's say 2, 3, 4, 6 points, that 6% of the loan amount. Okay. That's that mortgage lender's income when they sell that loan in the secondary market. That's what happens. Okay. So you as the consumer, yep.
Let me put this together for someone who doesn't understand this and doesn't work the way we do. And please correct me if I'm wrong, Patrick. Yep. So what happens if I go get a loan, and let's say I go get a loan from ABC Loan Company, right? Mm-hmm. ABC Loan Company is, I go to closing, I have my $300,000. They're selling that loan, or they're selling the servicing rights to that loan, so that ABC Loan Company now may become like a Wells Fargo or a Bank of America or some other servicer of the loan, correct?
Yes, exactly. Exactly. So you as a consumer, now your payments every month are going to that loan servicer, right, not necessarily the same company that originated your loan and brought you to the closing table.
Right.
Okay. Now, here's where it starts to get a little bit tricky. Okay. So once that mortgage lender that brought you to the closing table, once they sell it on the secondary market, they get that $300,000 plus a profit. They take that $300,000 and now they pay back their warehouse line of credit, the money that they borrowed to fund your transaction. Mm-hmm. That's an important piece in a couple of minutes. So just remember that the money they used to fund your transaction, they also borrowed. Okay. Now, every single mortgage lender has contracts with the companies that they sell to, the mortgage servicers they sell to, okay? And those contracts have a whole bunch of stipulations. Two real important ones are called an EPO and an EPD, okay? So an EPO is an early payoff, okay?
Okay.
So a mortgage lender is basically guaranteeing to the loan servicer that you, Maryann, as the borrower, you're going to make at least 6 payments, okay? Because that mortgage servicer, they're laying out, you know, a decent sum of money to buy
Right.
those servicing rights. Really, a break-even point for a loan servicer is 3-4 years out, okay? By the time they recoup the money they laid out to capture those servicing rights. So that loan servicer doesn't want you paying off that note within the first couple of months. So a mortgage lender that brought you to the closing table pretty much has to guarantee to that loan servicer that Maryann, as the borrower, that she's going to make at least 6 monthly payments before refinancing or doing something else to pay off that loan. So that's an early payoff. So when that does not happen, so when a consumer refis or sells the home or somehow otherwise pays off that loan within the first 6 months or before 6 months worth of payments are made, that mortgage loan servicer comes back to the company that originated the loan and sold it to them and say, hey, you didn't live up to your end of the agreement. Maryann didn't make 6 months payments.
Right.
You have to pay us back the 4, 5, 6 points, you know, whatever we paid you when we bought that loan. Okay. So in the business, it gets a little bit deeper. You know, serial refinances like that is called loan churning, and different loan products actually specifically prohibit that. But that's another conversation. Okay, so that's an EPO, early payoff. All right. Now, what's really at the heart of the matter of the current state of affairs is something called an EPD, early payment default. Okay, so that's when you, Maryann, you failed to make payments within that first 6 month period.
Right.
So if that happens, the mortgage servicing company that bought those servicing rights can come back to the company that originated the loan and say, hey, Maryann didn't make her payments. Here's a buyback request. Okay, so a buyback is when the consumer violates that the EPD, early payment default. They haven't made their payments anytime over that first 6 months. And that loan servicer can require the company that originated the loan to buy that loan back. So they have to give that loan servicer back the $300,000 and any commission they earned, whatever the 3, 4, 5, 6 points. Okay. Now, a mortgage lender is in a really difficult position. That mortgage lender, in most cases, doesn't service loans. So they can't have that loan on their books and collect payments. They have to sell it to somebody else. But that loan, that $300,000 loan, is not worth $300,000 plus, 4 or 5 points. It's actually worth less. It's going to be less than $300,000 because you have a loan where the payments haven't been made. So in order to get that off the books, most mortgage lenders are going to have to sell that at a discount. They have a $300,000 loan. They might only be able to sell it for $290 or $250, right. $260. So they're taking. So when there's an early payment default, the mortgage lender is going to be in a bad position. Okay, so I'm not crying for the mortgage lenders. Okay, I just want to put it into a context.
Is there a difference for them if let's say you get through 1, 2, 3 years of payments? You're me, I'm paying my loan. I get through 2, 3 years of payments, and all of a sudden I lose my job, and then I can't make the payment. Is there a difference between when you're further into the loan?
Beyond that EPD, usually the EPD is just for the first 6 months.
6 months, okay.
Early payment default. So it applies really, and contracts can be different. Sometimes it's 12 months, sometimes it's only 3 months. It's different. So I'm sort of painting with broad strokes here. Typical to the industry is 6 months. Okay, so if you're 2 or 3 years in, at that point, that's the loan servicer's problem. The company that originated the loan really has nothing to do with it at that point. Okay. So that's sort of the clinical definitions, if you will, of an EPO and an EPD. Okay. So in the current state of affairs, if a consumer, so Maryann, we've helped you close on your home.
Yep.
Loan is closed, servicing has been sold. You're a month into the transaction. with the mortgage servicer and COVID-19 happens, you lose your job. You apply for forbearance. Okay, and we'll get into the CARES Act and how that all comes about.
Mm-hmm.
But under the current plans, you apply for forbearance. Well, guess what? Many loan servicers are categorizing a forbearance as an early payment default.
Okay.
And they're going to force that company that originated that loan to buy that back.
Even if they're further into the loan, or does it only have to be in that 6 months?
Within the first 6 months. So it depends on what the contract is. And again, the contract is typically 6 months.
Okay.
So if it's within that contractual period, they're going to force that mortgage lender to buy it back.
Right.
So that mortgage lender that brought you to the closing table now has to buy back that $300,000 loan and find somebody else that'll buy it. Typically at a discount, they're not going to get the full $300,000 plus a profit. Okay. But what makes it even worse for that mortgage lender, remember when I said the mortgage lender has to borrow that $300,000 to fund your loan?
Right.
Well,
from
they
their
have
warehouse
contracts with their warehouse lines of credit. So when they have a buyback, that is a significant financial event. They have to, the contract is going to state, they have to tell their warehouse lender that they had a buyback.
And does that jeopardize their position with the warehouse
Yes,
lender?
the warehouse lender could terminate their line of credit.
Okay.
Which means that now they funded Maryann's deal, but they can't fund Patrick's deal or Mary or Jack or Joe's deal because now they no longer have that credit facility to borrow that $300,000 to fund the next couple of transactions. So it's a whole sort of, trickle down effect. So basically, it hasn't really come out to play just yet. It's going to take a couple of months to unfold. But as this happens, unfortunately, just that sequence alone is going to be enough to bankrupt a number of mortgage lenders.
So this is interesting to me in the sense that, obviously the government went into high alert and threw out all these programs that would try to stimulate the economy. You get your stimulus checks. They're doing bailouts for airlines, bailouts for cruise lines. Do you think we're going to see bailouts for banks again? Is that what you're saying? Is there a potential for this?
Yeah, yes and no. So I've got sort of a sequence as to how I want to explain this to try and tie it all together. So
Yeah.
Yes and no. Selectively there is. Okay. And I'll explain to you how that's working. And I've got a whole bunch of notes here. So I just want to make sure they sequentially explain this so that it makes sense. Okay. So the mortgage loan servicer, okay, once that loan is sold and we're beyond that buyback period, beyond that 6 months, they cannot force that originating company to buy that back. So Like I said, let's say you're 2 or 3 years into it. Okay. Now you apply for forbearance. So the mortgage loan servicer may grant that forbearance to you. Okay. But the mortgage loan servicer doesn't own the debt. They are simply a middleman. So think of a loan servicer as a building superintendent. Okay, they don't own the building, but they're knocking on the doors on the first of every month to collect the rent check.
Right.
They're fixing the blocked plumbing, the cracks in the wall, the electrical fixtures that aren't working. They're maintaining the building, but they don't own it. They're collecting the rent payments and passing it on to the building owner. Very similar. That's a very similar analogy to what a loan servicer is. So a loan servicer is going to send you your monthly bill.
Right.
They're going to collect that payment. They're going to manage your escrow accounts. And every month they're required to send a check to the
person that owns
the investor.
the loan.
Could be Fannie or Freddie.
Right.
It could be Black Knight. It could be a pension fund. Basically anybody who owns a mortgage-backed securities, mortgage bonds. Now here's the kicker.
Yep.
That loan servicer has to make the payment to the note owner, regardless of if the homeowner sends their check or not.
Okay.
Now, in a normal market, we might be approaching a 1% default rate. So there may be 1% of all borrowers in that servicer's portfolio that doesn't make a payment.
In a normal market.
In a normal market.
Right. Okay.
So in a normal market, the loan servicer is going to be liquid enough to still be able to send that full principal and interest payment to the investor, even if they don't collect it from the consumer at a 1% default rate. Okay. Problem is, we're well beyond a 1% default rate currently.
Yeah.
Okay? So again, just another sort of crack in the system here. How are these loan servicers going to continue to send checks to the note owners if right now we're at about a 5, and I have some stats I'll go over with you, but the quick summary is we're at about a 5.5% of all mortgages in the U.S., 5.5% of those are currently in forbearance. So the loan servicer is not collecting the payments from over 5% of their borrowers in their portfolio.
And that's right now. That's the
That's right. That is
now.
today.
Okay.
Well,
okay.
as of the end of last week. So the stats aren't current today. Within a couple of days, that's what the stats are. Okay. So even if that loan servicer, that building superintendent, if you will, is not collecting those payments, they still got to pay that out.
Right.
So I'll give you the quick hit on what the stats are.
And let me ask you, and I don't know if you know the answer to this, Patrick, because I want to draw a little bit of a correlation, but back in the 2008 crisis, what percentage weren't paying?
Well, I'd have to go back and take a look at the stats, but there's a real interesting twist on that, okay? Back in 2007 through 2010, there were all of these sort of, I guess we'll categorize them as rescue programs, loan modifications, and things like that. But in order to qualify, you had to demonstrate that you had some sort of a financial hardship. You lost your job. There was some other sort of economic event that was out of your control, okay? So in the business, we used to call it a hardship letter. So the consumer had to write and explain why they're facing a hardship. In the current state of affairs, there is no qualification. All you have to do is raise your hand and say, I'd like a forbearance. There is no financial requirement.
Okay.
Yeah, so I have the stats here. So as of April 16th, $2.9 million, is that right? 2.9 million consumers were in forbearance, 2.9 million loans, okay, which is about 5.5% of all mortgages being serviced. So the loan servicer is responsible. That equates to $2.3 billion a month that a loan servicer has to pay to the note owner. That's a huge amount.
And what happens if the servicers can't make these payments?
Yeah, so that's, I don't want to get political about it, but it's a political conversation. No, it really is. It really is, okay? So I'm not taking sides with or against the administration or any administration, but it's a political conversation.
Sure.
So an individual who has a presidential appointment by the name of Mark Calabria. So Mr. Calabria is the head of the FHFA, Federal Housing Finance
Authority,
which is basically the supervisory agency that holds Fannie Mae and Freddie Mac in conservatorship. Okay, so based on the 07 through 10 and all that happened, Fannie and Freddie were placed in conservatorship, and that's a whole other long conversation.
And I thought I thought I read last year that at some point they were attempting to come out of conservatorship.
Oh, but the feds won't allow that to happen.
Okay.
So Fannie and Freddie have paid back multiples of what the bailout was.
Yeah.
But what the feds are doing are keeping them in conservatorship and basically sweeping the profits out of their accounts at the end of every month. So again, a whole other political conversation. Okay. So for right now, for our conversation today, Mark Calabria, head of the FHFA, has basically said that there is no such thing as too big to fail. If these loan servicers cannot make those obligations, well, they'll collapse. We'll step in, meaning the FHFA will step in and will reassign that servicing portfolio to whoever's left standing. Okay? In my opinion, communism much? So they're basically going to come in, take away somebody's business and hand it to somebody else. Okay. Now, those are for the Fannie Freddie backed loans, slightly different twist on what the Treasury has done for the government loan. So for an FHA, VA, USDA loan, there has been a credit facility that has been created whereby those loan servicers, because this is really a temporary crunch, okay?
Right.
This is, 6 months, give or take, maybe, I mean, it all depends on where COVID-19 ends up. But, for the purpose of our conversation, let's say it's a 6-month cash crunch, okay? So the feds have made a credit facility available for the government loans. So the loan servicers that are servicing government loans, FHA, VA, USDA, they have a credit facility available where they can go and borrow the money for the principal and interest for the loans that are currently in forbearance and pay back the note owners, the investors in those. So for the government loans, I don't want to say it's business as usual. It's business as unusual, but there's no imminent collapse in that area of the market. What we call the conventional loans, the ones that are backed by Fannie and Freddie, we're on the brink. I mean, this could be disastrous. So all of the leaders in the mortgage industry have put together petitions, and they're out there, they're circulating. At the end of the call, I'll provide you with some links if you want to post this wherever you're going to post it. Basically, it's a petition to basically get in Mr. Calabria's face and say, dude, you're really screwing this up. This is an imminent economic collapse that is going to make 2007, look like a cocktail party. All right. So I don't want to be doom and gloom about it, but again,
that's part of my question for you today. I mean, some of this feels eerily familiar. Mm-hmm. Quicker, like this was a very quick.
Yeah.
And maybe it'll be a quicker recovery, but I think there's going to be residual effects.
Oh, absolutely. So the CARES Act. So a couple of contrasts between what happened last time around and what's happening now. So what happened last time around, it took weeks and months to really unfold and to see companies unwind and collapse. I mean, at the time when we were in the middle of it, it seemed to happen really quick. But looking back, it took weeks and months for it to unwind. And it took a long time for the government to step in and try to put programs in place to help the consumer and also help the mortgage industry. Okay. And, and I will point out, absolutely, without a doubt, it was the mortgage lending industry that caused the collapse last time. Mm-hmm. Okay. This time, it ain't my fault.
Yeah. It was bad loans,
Yeah. So this time around has nothing to do with the housing or mortgage financing sector, but we're, one of the industries that's really being impacted. So when you take a look back, it took weeks and months to unfold. You take a look at what's happening now, probably took a couple of days to a week for all of that to come unraveled. Okay, so pretty much overnight, what are called the non-QM, the non-qualified mortgage products, stuff that's not backed by the federal programs or by Fannie and Freddie, by private investors. So that's, the stated income stuff. And yes, that up until recently, that was still available in the market. Stated income, no doc type loans. When COVID-19 basically took hold and all the stay-at-home orders were put into effect, investors basically just backed away from the table and said, yeah, we're not interested in that, because the typical consumer that's taking out that type of loan is somebody, more or less in a cash business that, maybe doesn't show all of their income or can't show all their income. So they take out mortgage financing for a stated or no doc type of program. Well, you think who's in a cash business? Bars, restaurant owners,
right? Waitress, businesses, hairdressers, yeah,
exactly. And they're basically shut down. So how the hell are they going to pay their mortgage?
Right.
They're literally closed for business. So the investors basically pushed away from the table. I won't say all, but the vast majority of lenders in that space, about 48 hours, close their doors, no longer in business.
Wow.
That's already done. That's happened. That was 2 weeks ago. That's done.
Yep.
That's over. Okay. So when we take a look at what happened a couple of years ago to now, it's happening at a much, much quicker pace. Okay. So so from that sequence as to what's happening in the industry, you've got several different layers, and at each one of those layers, you could see that it's going to force a company or several companies just to go into bankruptcy. They can't handle and again, it's short term. It could be 3-6 months, but there's just not enough liquidity to manage that in the short term. And Calabria and the FHFA is not stepping in to help. Okay.
And that's something I want to get to today is like how bankruptcy, in your opinion, is going to, will it help or will it not help some of these people with these mortgages? I mean, if you're not working, from my perspective and what we deal with, we work with people who do either a Chapter 7 or a Chapter 13. Now, Chapter 13, they're allowed to stay in their homes, reorganize their debt, reorganize their payments, but they have to have the ability to show they can make those payments. So let's say they do a Chapter 13 and make an arrangement with the bankruptcy court to repay their mortgage and other debt, of course, over 3 to 5 years. And the bankruptcy court agrees, everybody agrees. Well, most of the time it's because that person is working and they can show that they can do this. I don't even know right now, is bankruptcy an option, or at least a 13 for some of these people?
Yeah, so I don't want to pass the buck on that, but I think that's really more of a legal question in terms of whether they meet the financial requirements to go into a repayment plan. Okay.
Right.
But actually, I think that's a good segue into explaining what's going on with forbearance and how that impacts.
Yeah. So